Welcome to the Explainer. Okay, today we're diving into a really wild corporate paradox and an incredibly bold solution. If you look at Perigo right now, you see a company living a double life. On one hand, they're absolutely crushing it at the retail shelf, capturing market share and expanding rapidly. But if you glance over at Wall Street, yeah, their stock and their profit and loss statements tell a completely different story. It's one of struggle and distress valuations. So how does a company bridge that massive gap? Well, they're attempting to do it with a groundbreaking new partnership. Okay, let's dive right into this. Here's how we're breaking it down. We'll start with the shelf versus the stock, look at the client zero revolution, and check out Module 1's financial impact. Then we'll scale up with the chassis model, explore the Wall Street payoff, and wrap up with the August 1st urgency. Section 1, the shelf versus the stock. Winning at retail, struggling on the P&L. Let's look at the critical disconnect that basically sparked this entire executive proposal. Like I said, Perigo is executing brilliantly on the ground. They're grabbing share gains in 5 out of their 7 categories, and they've literally tripled their innovation pipeline. That is incredibly hard to do. But their financials just haven't caught up to these operational victories. They're stuck with a lagging P&L and a really distressed stock multiple. The core issue here is that their hard-won operational wins are getting diluted by systemic inefficiencies before they ever hit the bottom line. All right, Section 2. The Client Zero Revolution, a zero-risk outcome-based partnership. This is where Perigo and Accenture introduce a radical new model to permanently fix that gap. Listen, this is definitely not your standard run-of-the-mill consulting arrangement. Client Zero is a fully outcome-based AI partnership. The absolutely crucial phrase to remember here is zero capital at risk. Accenture is funding the entire build up front. Perigo pays nothing, literally not a single dime, unless and until the independently verified results are actually delivered to their bottom line. Accenture has total skin in the game here. And this brilliantly illustrates how the compensation actually works. It's a remarkably clean split. For every certified dollar of value created, Perigo keeps 75%, and Accenture takes 25%. It's a flat rate locked in for a 60-month term. And remember, because this whole thing is outcome-based, zero certified uplift means a $0 invoice for Perigo. It forces total alignment because Accenture only makes money if Perigo's P&L actually gets better. Moving to Section 3, Module 1, Financial Impact. Proof before scale. Let's look at the immediate, practical proof point targeting OTC demand and retail velocity. Before you try to transform an entire global enterprise, you really have to prove the plumbing works. That's what Module 1 is all about, and the operational gains they're projecting here are massive. This AI integration targets off-engine forecasting and inventory optimization, aiming for a 15-point jump in weighted forecast accuracy. What does that mean in the real world? It pushes product fill rates from 91% to over 97%, and it drops inventory obsolescence, products expiring or just becoming unsellable, by about 40%. So when you translate those operational wins into financial reality, you get this number. Roughly $22 million in recurring EBITDA every single year, just from this one module. And because of that 75-25 split we discussed a minute ago, Perigo is projected to keep roughly $103 million over the 60-month term. This isn't abstract, fuzzy value. It's cold, hard, recurring gross profit, hitting the books year after year. But wait, there's more. And any CFO watching is going to absolutely love this part. On top of the recurring profit, Module 1 triggers a one-time working capital release of approximately $26 million. This is cash that was previously trapped in inefficient inventory and safety stock, suddenly freed up and handed right back to the business. Now, if you're a skeptic, you might be thinking, okay, but who decides if these metrics are actually hit? Well, that's what makes this model so robust. The results aren't just self-reported by Accenture. They're certified by an independent governor panel and backed by a PCAOB attest. Plus, this entire first module runs off-engine. That means it's highly practical, causes very low disruption to their current systems, feeds clean data directly back into Perigo's foundation, and even has a kill switch ready if things go sideways. Proof before scale. Section 4. Scaling the chassis model. The overarching opportunity. Once Module 1 proves the concept, the real systemic scale begins. Let's move to and see how this builds over the next 5 years. This is essentially the blueprint for an 8-tower transformation. By integrating systems across product lifecycle management, lab information, and regulatory information, this partnership unlocks what executive Abby Lennox calls the chassis model. It's a top-to-bottom modernization that aims to slash product time to shelf from a sluggish 18 to 24 months down to a hyper-competitive 6 to 9 months. Across these 8 towers, from demand sensing all the way to AI scheduling, we're looking at a combined annual opportunity of between $90 million and $300 million.
All right, Section 5, the Wall Street payoff, elevating the entire valuation. Now we pivot to what investors, analysts, and shareholders are really obsessing over. How does this reshape the stock?
The overarching goal here is to fundamentally re-rate the company based on these maturity metrics. We're talking about elevating the EBITDA margin from 14% up to 17%. Pushing core earnings per share from $2.52 up toward $3.29 or more, driving net leverage down from 4.0x to 3.7x. Ultimately, these fundamentals imply a share price near $30, which is nearly triple the company's current distress levels. And the best part? These aren't just self-reported guidance numbers that analysts usually discount anyway. These are independently audited, verified quarterly earnings driven directly by AI execution. Section 6. The August 1st urgency, a critical forcing function. With an opportunity this massive, why does the timeline matter so much right now? The critical forcing function behind this whole deal is a very strict 90-day clock. Launching Module 1 by August 1st is an absolute must. Why? Because it ensures the independent governor panel can provide their first certified signal by early September, which means when Perrigo has its earnings call on November 10th and Accenture has theirs in mid-December, both firms can point to a live, certified, capital-at-risk turnaround signal. If they let that August 1st launch slip, that window completely closes and both companies miss a massive opportunity to change the market narrative going into the winter. Prove it, then scale. That quote basically sums up the ultimate executive mandate here. Look, Perrigo has 138 years of deep industry expertise. That expertise is brilliant at winning at the retail shelf, but it desperately needs to be rescued and scaled on the P&L by AI. And with Accenture taking on all the capital risk up front, there are no more excuses. The choice is completely clear. Launch the module, let the data prove it works, and then scale it across the enterprise to get their valuation back. As we wrap up the explainer today, with our mandatory disclaimer up on the screen reminding you that these are forward-looking proposals and definitely not investment advice, I want to leave you with a provocative thought. We just watched how a consumer health giant plans to use a zero-risk, outcome-based AI model to completely rewrite its financial destiny. If a 138-year-old company can integrate AI to essentially guarantee profit outcomes before paying a single dime, well, how soon until this client zero model completely disrupts your industry? Something to think about. Thanks for joining me on this explainer, and I'll catch you next time.